Hey, are you thinking of buying AI stocks because you are afraid to miss out on their future growth? In this video, I'll discuss about the risk of investing in AI stocks like Nvidia by comparing the current situation with the Microsoft.com bubble of 2000. So let's dive in! AI stocks have been growing like crazy in the last few months, impacting the US stock market, which is nearing its all-time high. Investors are buzzing about the future potential of those stocks. If you had invested $10,000 in October 2022 in Nvidia, which manufactures and sells AI chips, your investment would be worth about $107,000 in June 2024. If you are tempted to invest in this stock today, remember that a similar situation happened during the dot-com bubble. Investors who bought the overvalued Microsoft stock at that time suffered a lot when the bubble burst. So here's the question. What lessons can we learn from those investors' mistakes, and how can you avoid the pain they experienced? I believe that there are two key lessons that we can learn from them, but before we dive into those, let me explain what happened to those investors. In the late 1990s, the internet was new and exciting. This new technology brought a lot of excitement, and everyone started companies with .com in their name, hoping to attract money from potential investors. Those investors followed and threw a lot of money at those companies, hoping that they would be the next big thing, even if those companies had not made a profit yet. Tech stocks benefited a lot from this internet boom, and Microsoft reached a peak of about $58 at the end of December 1999. The market ultimately crashed, and 1 year later, the Microsoft stock reached a low point of $23 in December 2000, dropping by about 60% compared to its high point of $58 1 year earlier. If this is a significant event for investors to digest, my question to you is, do you know how long it took for Microsoft stock to return to $58 a share after the crash? It took 16 years. This means anyone who invested at Microsoft's peak in the late 90s had to wait 2016 to recover the money they had lost. When we look at Nvidia stock today and the frenzy generated for AI, many similar things happened during the early days of the internet with Microsoft. If you do not want to find yourself in the shoes of the investors that invested in Microsoft at the peak of the dot-com bubble, there are two key lessons to understand. Ben Graham, Warren Buffett's mentor and the father of value investing, once said, "A great company is not a great investment if you pay too much for the stock." His statement highlights a fundamental investing principle, the concept of price and value. When you invest in a stock, the price is what you pay, and the value is what you get in return for that price. The value of a company is what it is worth today when you consider its competitive advantage, the management, and the potential earnings or cash growth in the future. The price is what people are willing to pay for this company in the stock market. There are two key issues when you pay a price for a great company that is overly higher than its value. The first one is that when you pay a price significantly higher than its value, the market price may already reflect overly optimistic future expectations. In this specific situation, the room for growth is very limited and often relies on the hype around this stock. It puts you in a situation where the risk of losing money is very high if the hype stops, and the bigger the hype, the bigger the drop. The second issue is that when you pay a price higher than the value of the stock, you do not pay a price that provides you with a margin of safety. A margin of safety is the buffer between the price you pay and the value of the stock. If you estimate that a stock is worth $100 and you buy it for $50, that provides you with a 50% margin of safety. This buffer is important because it protects you from the risk of losing money if anything goes wrong with your estimated future prospect of this stock. People investing in Nvidia stock today or any other overvalued AI stocks do not seem to care about paying a price that will provide them with a margin of safety. This view has recently been shared by Monish Pabrai, who is one of the best value investors in the world.
We have a company in the US called Nvidia, and Nvidia just hit $1 trillion market cap, and it's up almost like 200% this year in the first 5-6 months. And Nvidia is a great business. It's a great business. It's at the epicenter of the AI boom. And a lot of people think that Nvidia will do really well. I don't have any position in Nvidia, and I'm not suggesting you should go buy the stock, but I'm just using it as an example. So I would say that there's a lot of euphoria around Nvidia. And if one were to do some type of analysis of a discounted cash flow model, where you look at the earnings of Nvidia today and you do some projections of what you think their earnings are in 3 years or 5 years or 10 years, and then you discount it back, I think it'd be difficult to justify the $1 billion or $1 trillion market cap. It'd be difficult to come up with a future cash flow stream in the next 10 years or so that would exceed that. I have no idea what would happen to Nvidia, but I would just say that what I have noticed in equity markets is that they vacillate a lot between fear and greed. They tend to at times get very overheated and overvalued, and they tend to get very depressed at other times. And because it's auction-driven markets where prices are set by the sentiments of investors, there's a lot of positive sentiment about Nvidia. It's a great business.
The same hype existed around Microsoft during the dot-com bubble.
Similar sentiment existed in early 2000 with Microsoft. And so I remember that when I started my fund in 99, one of the first individuals, probably the first 20, 30 investors I had, was a guy Indian guy who had risen quite high in Microsoft and had retired early. And he was one of the very early employees of Microsoft. He knew Bill Gates well, worked closely with him, and so on. And he had made an investment in Pabrai Fund. Then he told me, "Hey, listen, if you're ever in Seattle, I can introduce you to a bunch of current and former Microsoft people, and these guys are quite wealthy. They've got a lot of stock options from a long time ago, and some of them may be interested in investing in your fund." And Pabrai Funds was very new, just like a couple of $1 million, $2-3 million in assets. And I said, "Oh, I'm going to be in Seattle day after tomorrow." So he said, "Oh, that's great." So he walked me around Microsoft, introduced me to different people. A bunch of them later invested with me. But I told many of those individuals I met that their livelihood was coming from Microsoft. Most of their net worth was in Microsoft stock or in Microsoft options that had been granted. And when I looked at the Microsoft market cap at that time in early 2000, it was over 600 billion. It was in the top 3 most valuable companies in the world at that time. The top 3 most valuable companies were Cisco, Microsoft, and General Electric. None of those would have been a great investment if you put, a portfolio 1/3 each in these 3 investments. GE has basically, for practical purposes, disappeared. Microsoft never saw that 600 billion market cap for the next 13 years. And in fact, it took a huge drawdown. I mean, the 600 billion went down to, I think, less than 100 billion or so, thereabouts. So it was a huge drawdown. It's now at a much higher valuation. So it's done really well. But I think from 2000 to 2012 or 2013, it would have been a very, very rough and bumpy ride. And I don't know anyone who would have held on to their stock through that ride. And the Nvidia situation today, so the history doesn't repeat itself, but it does rhyme. And when I look at the Nvidia situation today, to me, it rhymes a lot with the way Microsoft was at that time.
The best way to avoid the mistakes of Microsoft's investors is to stay rational and avoid emotional type investments. If you are tempted to buy Nvidia stock today or any other AI stocks at their current price, you are probably letting your emotions guide your investment decisions. The stories likely going on in your head are like this. You see others making quick profits and don't want to miss out on the potential gains offered by AI stocks. If everyone is making money, there is a chance that you could also make a large profit quickly. You believe that those AI stocks will keep rising because there is so much media coverage and positive news about AI advancements, creating real excitement for this new technology. You become very optimistic about your investments since the majority must be right. The problem with this investment approach is that the price you end up paying for those AI stocks is not justified by the company's fundamentals. It's merely a speculation rather than an investment. If no one can predict the market and tell with 100% confidence when all this will stop, the market ends up always correcting itself. If you are still invested in those overvalued companies when it happens, the drop you will experience in your portfolio might be brutal and you might have to wait for a long period of time for your stocks to recover. It's very difficult to invest and select the winner of a new technology because there are so many unknowns that we are dealing with. The biggest winners of the internet boom were not necessarily the biggest companies at the time. The same will probably happen with AI. I recently made a video explaining how your emotions can prevent you to invest like Warren Buffett, and if you are interested about it, you can find it either on the screen somewhere or in the description. This is it for today, guys. If you got value from this video, feel free to drop a like, and if you want to receive more contents like this, feel free to subscribe. Thank you all and peace out!